Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. She is a tax expert for small business owners and individuals. When it comes to filing taxes, we were talking about some of the different rules that go, and this goes to small business owners in particular. There's something called a Simplified Employee Pension Plan, or SEP. The SEP IRA is kind of unique in this, in that other things like your 401ks, 403b, a 457, TSP, which is thrift savings plan, all these company plans, you have to make your contributions for 2017 had to been made actually by December 31st of 2017. So if those any contributions made this year count for this tax year in those type accounts. Roth IRAs and traditional IRAs, you have until the tax filing deadline, the first one, which is this year, April 17th. So you have until April 17th to get those monies deposited in for it to count for 2017 if that's what you're seeking to do. Past that date, they're going to again count for the 2018 tax year. And so the one exception that goes beyond that tax date is this SEP IRA. So if you're a small business owner, if you've got self-employed income and you're able to have a SEP or a SEP IRA, or want to set one up, you technically, if you file your extensions, and this is the key, if you're filing your taxes by April 17th, then you have to make that deposit by April 17th. Or if you file the extensions, you can go until, it gives you until October 15th to still be able to even set one up. You can even, you know, you could come in, you know, I'm not going to say October 14th, because that's like a really bad idea.
October 1st, and still establish and fund it for the prior year.
That's it. So we can come in, we can set you up a SEP, and we can fund it as long as we make it in by that October 15th deadline. That would still count for the 2017 tax year. So, this is one of the areas with SEPs. You depending on your income, I think it's 25%, something like that, that you're allowed to put in, up to $18,000. I think for the 18,000 under 50, and if you're over 50, I think there's a 6,000 catch up on that. So up to 24,000. Just like with a 401k, by the way, you can put up to 24,000 of your own money in, and in addition to that, whatever matching you may get from the employer. So there's a lot of ways you can. I mean, if you're behind, it's a great way to set up. You know, one of the things, by the way, when it comes to that, the biggest thing I see for people is that, you know, we talk about investment returns, we talk about safety, we talk about minimizing taxes, but one thing that you can control the most easily is that of being a good saver and putting that money away. If you don't do that, all the rest of it's not going to matter.
It's hard to complain when you don't have anything with retirement if you don't take it now, right?
Yeah, you know, this is it, saving for that retirement. Now, when it comes to taxes, one of the things to keep in mind, distributions we were talking about. So we're talking about how to get those monies in so you get the tax deductions. And then here's another thing to think about on that tax deduction part when it comes to tax deduction part, excuse me, with IRAs or retirement accounts in general. What bracket are you in? You know, if you're in a 12% bracket, is tax deferral going to be as important if you're only going to pay, say, 10 or 12% tax on that money? And then when you retire, you know, is your income is your tax going to be any lower, or is it possible it could be higher? These are things to weigh. So maybe it's not, if that's all the deduction you're going to get, maybe that's not a big deal. Now, if you're in a 22, 24 or higher brackets,
no question,
then tax deduction is probably going to make more sense for you.
Yeah, and true. I mean, I think a lot of times people ask their tax person that particular question, and I think that's a bad person to ask, because almost any time we can save you tax dollars, we're going to try to save tax dollars, right? We're not looking at the big picture, which is what his job is, not mine. Mine is instant gratification. I can save you $500 if you put $6 grand into your IRA or whatever, even if it's only 10%. But, you know, it may have not been the best thing, because if you could have deferred it, and when you hit retirement age, and maybe not making your Social Security taxable and keeping you in a basically 0% tax bracket at that age, and basically paying very little this year or current years, would have been a smarter move. So I do think you need to double check that with your financial person anytime you're making those decisions, because a tax person is always going to lean towards what's going to save you tax dollars today.
And we have a tax, with the new tax law, we don't know if this is going to be permanent, right? This has got a
7 years right this second.
Will they extend it? Will they not? Well, if they don't, and all of a sudden taxes go up, again, having paid this cheaper tax. And when we look at historically, by the way, to put this in perspective, 20 years ago, you would have been, you know, someone making $50,000 is in a, say, a 12% 12% bracket right now. Back then, that bracket would have been, I think it was like double that. It would, or actually, it was around 30%. It was 28%, I think, exactly. So 20, and then if you go back 30 years, it would have been up around 49%. So tax rates.
What's your point?
Tax rates are at historic lows.
Yeah.
Right, we haven't seen rates like this in I don't even
our
know.
lifetime, my lifetime.
Yeah, maybe even going back to the inception of income taxes. So this is a very low tax rate, which is great. I mean, let's take advantage of it. Let's make this goes back to what I was saying. So if I pay tax, if I pay that 12% tax, let's say, if that's where the bracket I'm in, and then when I retire, if the taxes do go up, I've already got that money sitting in a Roth, for instance, instead of in a taxable account or a tax deferred account that I'm going to have to pay income tax on. And understanding, again, when I put money into these retirement accounts, this is one of those areas I've talked about quite a bit. If I've got, think about it this way, if you've got, let's say, $500,000 sitting in a retirement account, all right, depending on your tax bracket, how much of that is really yours? Okay, you're going to be paying a tax rate maybe 20 to 30%, exactly, maybe 20%. So you're looking at, on 500,000, what does that mean? That means maybe 100 to 150 of that's got to go to IRS and taxes. Right. Learning how we can reduce that down, if we can get that down to 10 or 12% instead.
Wow, that's awesome.
Think about it. I mean, this is a huge savings. So now maybe 50, 60,000 in tax instead of 100 to 150,000 in tax. So that's one of the areas why, when it comes to taxes, understanding it could be worth literally, hundreds of thousands of dollars to you over your retirement lifetime if you can, be disciplined and learn how to do these distributions. And that's what I do with clients. When we do reviews, the reason I like to do 2 reviews a year, I like to do tax planning. I like to talk about the income piece when we're taking money to supplement the income needed to maintain your standard of living and quality of life. How we take that money out is huge in terms, and how we set it up to, for the time when we're going to take those distributions can be huge in terms of the amount of money that you're going to get to keep for you and your family. Yeah,
and it's also important because the fact is sometimes people are like, well, I don't need the money. It's in my IRA. I don't need it right now. But the problem is when the RMDs start kicking in, it really kicks them into a very high tax bracket where if they had maybe started early or taking smaller portions out to bring down that IRA or 401k or whatever it was, you find out that sometimes controlling it, you have control of it. Maybe it's better to pay 20% across the board than kicking yourself into the highest tax bracket when you have to start hitting the required minimum distributions versus, then it's mandated and you don't have any choice at all. So sitting down early and getting that picture of that plan is a big tax saver as far as I can see.
Yep, we're gonna, we're back up to break time again, so we're gonna take a quick break, but when we come back, I wanna dive into that a little bit about these required minimum distributions, how that works, when you have to take them, what is the amount that you have to take, how to use those rules to your advantage, by the way, and understanding by planning ahead, we can maybe minimize that, and again, minimize taxes. We'll also talk about Roth conversions and how those work. Lots to do. Lots to do. Join us here, we'll be right back on the Retirement Report.
Are you